We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovic. Joining me today is Dr. Marc Faber from the Gloom, Boom, Doom Report. How are you today, Dr. Faber?
I'm fine, thank you very much, and I hope the same for you and for your viewers.
Thank you very much, and it's great to speak with you again. So I'd like to kind of start talking about the markets. So in your latest report, you say that the latest high in the S&P 500 was not confirmed by the volatility index. So if we combine this data point with the fact that we also encounter the rare occasion where the major indices are making new highs, while at the same time, only 50% of the S&P stocks are still above their 50-day moving average, what do these two indicators point to for the US stock market? And is there a wider global theme of this weakness overall as well?
Well, I think if we look around stock markets in the world, most stock markets have underperformed the US for a long time, over half a year, over 1 year, over 10 years, and so forth. And so the US is at a very high level. But then if we dig a little deeper, we can find that in the US, some stocks are very high and expensive, and other stocks are much lower, whereby we have to keep in mind that each time the Federal Reserve prints money, it actually is a tonic for corporate profits. So you print money, the money doesn't go to the worker on the street, the small guy who works or tries to work, because now the government tells him he's not allowed to work, he's not allowed to keep his place open, or they regulate him to such an extent that it's no longer profitable. But the money has flown into corporate profits and into the coffers of what I call the super, super rich. So this is what has been happening. And in the market, you find everywhere in the world, lots of stocks that are inexpensive, and then some stocks are very expensive. Like in recent weeks, we've been seeing some sectors in China collapsing. The sectors that have been weak have been technology related, and more recently, in the last 10 days, education stocks. But other stocks that had previous bear markets, like I'm a holder of China Mobile. It's a mobile phone company, communication and so forth, a dominant company, I'd say. The stock has been actually moving up over the last 2 weeks when the market was weak. Similarly, other Hong Kong stocks that are value stocks that have been very depressed before everything started, they've been holding steady. So the markets, we have to be very careful in the analysis because it's no longer a homogeneous affair. Like, as I just said, 50% of stocks are above the 50 days moving average and 50% are below. And you look at the transportation index, it is not making a new high. It's actually down 10% from the high. And this is an economically sensitive index. You look at European markets, you look at Asian markets and emerging markets in general, they've all been down, partly also because the dollar has been strong. So you can have the impact A of a strong dollar and B on relative, let's say, unattractiveness of emerging market economies, and less money is flowing there and more money flowing into the US, into anything it doesn't matter what it is as long as it moves. You understand? We had the meme stocks, we had SPACs, and so forth. The value of all these companies is very debatable, but as long as they move up and as long as there is a high volatility, in other words, day traders can buy and sell, these stocks are perceived by the speculative money as attractive. And lately it's been the Robin Hood cult.
So in your view, Dr. Faber, is this the V-shaped recovery from the initial lockdown of, let's say, March 2020, is that starting to wane and reality starting to set back in for, let's say, profit expectations for these companies?
I believe that this is the case. We had an enormously sharp drop, 35% between February 2020 and March 2020. In other words, within a month, we dropped 35% on the S&P. And then we had a strong recovery. And now to really, for stocks to move up above the level they were in 2018, 2019, for some stocks, it's already happened, but for a lot of stocks, it hasn't happened. And I think now it's becoming more difficult also because, and this is an unusual situation, we have easy monetary conditions, otherwise the markets wouldn't be up. But within very easy monetary conditions, you can have a relative monetary tightening. And it seems to me that this is now the case. Also, the fiscal deficits are no longer expanding. They're still very high, but they're no longer expanding. So you have diminished fiscal and monetary stimulus. And that makes it now more difficult for all asset prices to move up. It doesn't mean that some assets can't move up, but for all of them to move up is more difficult.
So can we point towards inflation pushing up the cost of doing business and lowering the affordability for consumers a major factor at this point in time?
Well, I think you're raising a very good point that the politicians obviously don't want to talk about, and the central bankers even less. What has happened with the current monetary policies is that for a large number of people, say the average American, many things have become sort of unaffordable. You understand? When I went to school and when I started to work in the 70s, I can measure how much my salary was and what the cost of a house was. And I can say, with that many hours of work, I could buy a house, or I could buy an ounce of gold, or with that many hours, say 25 hours to 30 hours of work, I could buy one Dow Jones Industrial. Now, to buy a Dow Jones Industrial, I need something like 160 hours of work. In other words, compared to salaries of the average person, not to the income of Warren Buffett and Jeff Bezos and the lot, but to the average American, the cost of buying something is very high. That there's no question about this. And this has come about because of these, what I call irresponsible and poorly considered monetary policies by the Federal Reserve and, by the way, other central banks. They have increased the cost of everything. And lately there has been this discussion about inflation. All I can say about this is the following. When you embark on money printing, when you embark on fiscal deficits, to stop is practically impossible. it will continue. And if I look at the current monetary setup, we have the following situation. Some people will argue current rate of cost increases is 10% per annum. Some, like the government, will say consumer prices or whatnot are rising at something like 3-4% per annum. But I can say that current interest rates are, say, at close to zero on deposits. On the 10 years note, it is, say, at 1.3, 1.4%. So if I compare the rate of inflation, whatever inflation you take, 4% or 10%, and I take the rate of interest rates today are as negative in real terms, inflation adjusted, that is, as they were in the 70s when we had a continuous acceleration of inflation. And all I can tell you is some prices have come down. You know, lumber went up to $1,600, and now it's back to below $600. But it's not going to drop again to, say, $200-300. And the same for a lot of agricultural products, the same for food products that you buy in the supermarket. All these prices, they go up relatively easily, and they're sticky on the downside. So my sense is that we have a price increase. Maybe the price increase will slow down, but for sure, this price increase we had and still have is lowering the purchasing power of people's incomes. And people, even if they get a higher salary now, they're going to get squeezed. And all I can say is that young people today, they earn less than their parents did 30, 40 years ago. In real terms, inflation adjusted, and they have less money than their parents had 30, 40 years ago. In other words, by printing money, we are now at the stage where we are diminishing the standards of people, not increasing it. But, well, the standard of living of Jeff Bezos and Musk and all these people cannot be increased. It's already at the highest level possible. But their wealth can be increased. And that has been happening largely, and I repeat, largely because of monetary policies.
So, Dr. Faber, with this, you know, the effect of your viewpoint, your time in the industry, and the amount of history that you have studied and focused on, do you think that at this point we're just going to basically see this, in a way, the stair-stepping pattern of increasing costs, up, a little bit of consolidation, up, a little bit of consolidation?
Well, my sense is that if I look at central banks, and especially the European Central Bank and the Federal Reserve, it would seem to me that monetary tightening is practically out of the question. You know, I think what the central banks have created is an environment where asset prices are so much inflated that if asset prices came down 10-20%, it would cause significant economic damage. And I don't think that they would do that. It may be intellectually in their minds that, yes, we will have to address inflation at some point. But in reality, they will opt for inflation rather than have an economic chaos or an economic recession that would be even more painful. Maybe not. In the long run, both outcomes will be very bad. In my opinion, the money printing outcome is in the long run going to be much worse than if they took now the pain, or if they had taken the pain in 2008, 2009, or if they had taken the pain in 2003, 2004, where all these bright economists said, well, what we need is to create a housing bubble to stimulate the economy. You understand? The Fed and their lackeys, economists, they're not economists, they're just kind of voodoo doctors. They have been creating one bubble after the other, starting with the intervention to bail out LTCM in 1998. That gave a signal. The Federal Reserve is like the fireman that will attend to any problems that may arise in the financial market. They will step in and bail out the system. That's where we are today. And I don't think it will last much longer. But you understand, within 1,000 years, 5 years is a short period of time.
It absolutely is. And it's always interesting to kind of take that perspective of, you know, we may not have thought that this could have continued, but like you say, in a relatively short period of time, it can. So as we were talking about interest rates, how likely is it, do you think, that we will see interest rates in the US start to increase in the next few years?
Well, my sense is that we've seen the lows in August 2020. We then had a sharp increase in interest rates from less than 0.4% on the 10 years to almost 2%. Then recently bonds have rallied, in other words, interest rates fell again. But I think that we will not make new lows in interest rates, that we are definitely closer to a low than to a major high. And that from here on, the risk of higher interest rates eventually is very high, is very significant. But if you print money, you can manipulate markets for a while. You understand? You can keep interest rates low for longer than they would have been under a free market. But eventually, the market will destroy the interventionists. That is clear. So, whereas a few weeks ago, actually 3 months ago, I said to my investors they should be long treasury bonds, that they would rally. And they rallied this year, treasury bonds, by more than 15% between March 15 and 2 weeks ago, or 10 days ago. But I think this rally is pretty much over. And in other words, the decline in interest rates is over. And from here onwards, we'll probably get rather higher rates than lower rates. And eventually, much higher rates. As I mentioned to you, in real terms, interest rates are extremely negative. Extremely negative. Which should be supportive, it should be supportive of stocks. It should be supportive of everything, Bitcoins and cryptos, and also of gold and silver. But as we've just seen, within this supporting easing and monetary measures, we can have significant declines in the one or the other sector of the market. So
would the Fed ever allow that to happen, allow the interest rates to get high enough that it starts to affect their payment on their loans?
Yeah, well, this is a very good question.
Seems they're stuck between a rock and a hard place.
There can be a situation where, when you look at monetary policies, the central bank has a lot of control over the quantity of money and the price of money, which is interest rates and so forth. But where they have less control, and they have no control over interest rates in the long run, but they have less control in a free market over the foreign exchange market. In other words, we have nowadays essentially free foreign exchange markets. In other words, the dollar can move up and can move down. That may change one day. They could essentially fix the dollar at a certain exchange rate and so forth. But if you keep, let's say, we have a situation where inflation accelerates, and it becomes to everyone obvious that inflation is now, say, permanently above 3-4%, and still rising. You understand? These are dynamic processes that reinforce themselves. So we could essentially, with more money printing, we could go to much higher price increases. And then at that point, the dollar may weaken at some point, at some stage. And when the dollar becomes very weak, it then reinforces the inflationary trend. You understand? Because the US imports a lot. And that can create a situation where, in theory, the Fed is not powerful enough to stem the tide. Of course, they can buy all the bonds that are sold by foreigners. They can buy all the bonds that the government is issuing through the deficit financing. They can do that. But the dollar then tumbles, you understand? So that's why I say the Fed, in my opinion, is not in a desirable position. Gold holders, we gold holders, we all lost some money in the last week because gold is down. But I can tell you, when I look at central bankers around the world, of course, the problem in today's democratically elected governments, nobody ever goes to jail. All these are criminals, basically, but they don't go to jail. And whether they are good Fed chairman or lousy Fed chairman, they all get the same money compensation at the end of the day. And they're all hired by Goldman Sachs as an advisor and by the big hedge funds and so forth. So there's no risk. A central banker has no risk, which is wrong. But these characters, they will then, to keep the system together, they will do certain things. And in my view, this whole business of tightening money and easing policies began long before COVID. It began in August 2019 when the repo market tightened. Then they began to ease again. And by the end of 2019, the assets of the Federal Reserve had again reached the previous highs. So, but I think COVID is connected to it, because maybe suddenly they thought it's not sufficient. There is a problem. So let's create a crisis, and then we can come in and kind of print money, so we can blame COVID for the money printing. But I don't know for sure. But one thing I can say in good conscience, and having studied essentially most inflationary periods, it would seem to me that once you open the toothpaste, and the toothpaste is out, to bring it back in is very difficult. And this goes with inflation. It may not be, an inflation that right away accelerates all the way up. I have now under study the inflation of the French Revolution. It's very interesting how many parallels there are. But anyway, during that time, there were periods of actually prices not going up and the currencies actually rising, and then everything got hit again. And my prediction, and that's that I would tell all your viewers and everybody, I think volatility will go up. We've seen it now in the precious metals. It's been very high volatility. And people that had borrowed to buy these investments, they got slaughtered. So as long as you hold something in cash, you're okay. But if you borrow money, you have to better be prepared that you may have to sell or you may be forced to sell. But anyway, this is where we are nowadays. And of course, Wall Street and the government will tell you all is fine and the economy is recovering and so forth. But I don't need to travel a lot. I just need to open my eyes in the area where I live. I live in the second largest city in Thailand. I can tell you, in my opinion, the economy here is down at least by 30%, minimum. Even big businesses like 7-Eleven stores have started to close shops. These are businesses that are owned by the rich people, you understand? The shop is a franchise, but the chain is owned by wealthy people. And these people, when they close down shops, they must smell that it's not going to get any better anytime soon.
So has any of this environment changed your views on holding precious metals, or has it really increased your conviction in the importance of holding, as you point out, about a 25% allocation to the metals?
Well, as you know, I never sell precious metals. So my precious metals portfolio is, of course, down over the last 10 days. Do I cry about it? No, because I have no borrowings. And actually, I wished gold would drop, say, another 10, 15%. We are oversold here. You understand? This morning when I woke up in Asia, gold was trading briefly below 1,700. I thought, should I buy this gold as a trade? I didn't do it because the banks were still closed in Asia and so forth. But, and also, how much money would I put into that trade? Would have been limited. But as an idea, I think we may still go lower. But we need to, of course, think, and this is the last thought I want to introduce, does the precious metal market kind of signal something people are not prepared about, namely that there could be a significant asset deflation. You understand? If gold and silver drop by so much, maybe it tells us stocks could drop by much more soon. Or you understand? The point I want to make is maybe it's a message by the market that despite all the money printing of the Fed and other central banks, asset markets are so grossly inflated that they could have a meaningful setback. I mean, we had a meaningful setback in Bitcoins, which dropped by more than 50%. Now it's rallying again. But will we make new highs? Who knows? I'm not predicting here anything. But I think that the gold and silver tumble we experienced tells us that other assets could be very vulnerable. That would be my interpretation of the message.
That there's a lot more volatility here possible in the shorter term.
Correct.
So, Dr. Faber, what other types of asset categories do you find attractive to at least, hold some purchasing power in your portfolio right now?
Well, I think if I look at Asia, I'm still a believer in Asia, but one condition is peace. I'm worried that once the COVID story, or some people call it a scandemic, a scamdemic, And once this is over, they'll find that the economy is not doing well because they can't print much more money and they can't increase the deficits and so forth. So they'll find a new thing, a new gimmick. And the new gimmick will be either Iran or Russia or China, and they'll go to war. You understand? In previous times in history, only countries could go to war that had the money. But now that we can print money, everybody can print money and go to war. And when you ask, well, how will you repay it? The people say, well, that's not our worries, it's somebody else's worries. So you understand, there is not much of a constraint to do some stupid things. It's like once you print money, you can spend money, 10 billion here, 20 billion there, and so forth. It's all about politics, has nothing to do anymore. The politicians are not doing what is good for the country, for their constituents. They are doing what is good for themselves, to be re-elected, for their power base. And so we have more and more power concentration among government officials, mostly unelected officials, bureaucrats like the CIA, the FBI, and so forth. These are powerful organizations. If they don't like you, they come and take you out. I guarantee you.
So
you better be nice, In
that same
they
kind of...
They probably also have an office in Thailand, so I also have to be nice.
So in that same kind of idea, Dr. Faber, when we think about the amount of control that governments around the world have taken over the past year, let's take, for example, the evictions moratorium that's recently been extended in the US in a way of really seizing control of landlords' property. So why is the population not more upset by this?
The population is not so upset about it, because the government goes and says, well, you landlord, you can't collect rents. But the people that pay the rent, they're very happy. And the landlords, the fewer landlords than people that pay the rent. So, and the government then prints money and gives them money to the landlords or something like this. But I can say one thing with some confidence. Eventually, the landlords will get back and they'll charge people for their rents, and the rents will be much higher. That we have to consider. But as you know, the big landlords are very powerful people. But I think in this whole saga that is going on, it will get bad and it will get worse. I think people that think we're going to go back and everything will be normal, forget it forever. You better get used to the fact the way it is now. That is your future. It will be unpleasant and it will get much worse, much worse. And when this all happens, the bureaucrats will then go after the rich people. In every society where you had high inflation, eventually the government went after the rich people. So this is kind of my playbook. Anyway, it was very nice talking to you.
Thank you. Thank you so much for your time, Dr. Faber. I really appreciate getting your thoughts around this.
We look towards a very bright, dark future. Bye-bye. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.